With that, I wanted to thank our special guest today, which is Gershon Distenfeld, who is not only somebody who I know personally, but from the professional perspective, he is somebody that I've been watching and admiring for many, many, many years. He is knowledgeable well beyond anyone and everyone's true understanding of how brilliant this guy is. And I always tell my guests that I will do them injustice in my introductions and how I interview them because, you know, this is not my profession. I'm a mortgage banker. This is what I do for a living. But at the same time, during these challenging times, I've been reaching out to people, trying to get some guests on to do some, you know, educating, entertaining, and some encouragement to people. And I think in this particular case, Gershon, who is somebody who is well-versed in the bond and markets world, is somebody who I thought would be an excellent guest to join us and just talk about what's going on in the market. He has a very level-headed understanding and just the fundamental beliefs of what he sees and what's going on. And I would love for him to share his comments with us. And with that, I would like to welcome and thank you, Gershon, for joining us. First and foremost, how are you holding up?
I'm doing okay, Shmuel. Thank you for that overly kind introduction. I don't know nearly as much as you think I do, but thank you.
Well, unbeknownst to you, I've known about you since my high school days. We have a lot of common friends in common. We did not grow up together, but literally at a very young age, I heard about your brilliance, and not really just saying that to blow smoke, just to say that it is rare that somebody, and I say that's really gonna be my first question. How did you get into this career? Did you always want to get into you know, the money management? You've been with this company for a long time, so why don't you just talk about, you know, what you do and how you got into this line of work?
Yeah, well, look, I had a mathematical background. Like most people, I followed the stock market as a kid. Didn't really know much about the bond market, and I kind of fell into it more just, you know, randomly. Got a job at Bernstein about a year after I graduated Yeshiva University, and just got a job in the fixed income area. And one thing led to another. I ended up in the high yield group, and that's where I built most of my career. I ended up running our high yield business, AllianceBernstein's high yield business, for many years, and eventually I became co-head of fixed income. So I've been with the firm about 22 years. I've had a pretty nice career. I'm responsible for about $300 billion in assets under management across a wide variety of fixed income instruments for clients worldwide.
That's amazing, and clearly you're no joke. It's no joke, and you know what you're talking about. I think one of the things that I commend and respect a lot, in addition to so much on a personal and business level, which I know about. One of the things that I respect is the fact that you've been so consistent. You're in the same firm and you worked your way up. You've seen a lot. You've literally built a career, and they've built their business on your back all the way up. So you've been around the block. And my question to you is, have you ever seen such a thing? Have you ever seen what we're seeing right now in all of your years?
Well, you know, I've learned never to be surprised. You know, I had a quantitative analyst in 2008 tell me that this, that, and the other was a 13 standard deviation event, which, based on pure mathematics, is supposed to happen once every trillion years. So I kind of thought I was covered for the rest of my career. So I kind of refused to believe this is actually happening. But look, every situation is different, right? Every day you know, my inbox was flooded yesterday with just, you know, even people outside the business saying, how can oil trade at a negative value? How does that make any sense? And I think we're going to see a lot of those types of anomalies. We're not in normal times, and supply chains have been disrupted. We're going to see things that we haven't seen before. We should continue to expect to see the unexpected. That shouldn't be abnormal. That's going to be the new normal for a while. So no, yes, on the one hand, we haven't seen things like this before, but we should continue to expect to see that going forward.
And that's a great segue for what I was going to say, which I started to tell you when we first joined, which is I mean, as much as your business is about not forecasting and not predicting, but trying to use research and analyze what's been happening in the past to make decisions and judgments and strategies going forward. I was blown away by the fact that I don't know when you were on CNBC or Bloomberg, March 8th or 11th or something, and they were just asking you for your final thoughts on the panel. And you're like, well, look, you know, I don't want to be an alarmist. I'm not an alarmist. And I think that was how they even prefaced the question. And they said, well, Gershon, like, where do you think, you know, things may happen if, you know, things don't really go as calmly as we think? And you predicted that United States may get shut down. We may be homebound. We may be seeing disruption in all of our markets and services and industries. And literally, you called it. You got it. You nailed it. So, why did you think that? And what did you see at that point that caused you to think that way? And the truth is, do you think we can bounce back from where we are? And
Yeah, so look, it's a little ironic because those who've been following me know I'm probably the first person to tell you that nobody can predict the future. In fact, investing, it's a misnomer. People think that good investors are able to predict the future. It's actually not true. No one knows what's going to happen next. Good investors actually are able to assess probabilities and build their portfolios accordingly. But I think what I saw was, I don't think it was about predicting the future. I was assessing the present. I think people just didn't want to believe what was right in front of them, and that fear was taking over. You know, people go after headlines, and you already saw it. If it was happening in other countries, you saw what was happening in Italy, and the headlines were that, you know, this was spreading. There were clearly death is something that grabs people headlines, and it was just inevitable. It was gonna spread to our shores, and we were gonna take drastic action. I personally am not sure that we've done the right thing here. It's a false, you know, this idea that, you know, if we prioritize the economy over people's lives, that's a bad moral choice. That's not the thing here. Shutting down an economy impacts people's lives up to and including death as well. I'm glad I don't have to make those decisions, because I don't know how you make those decisions, right? The fact that we've shut down the economy is going to lead to a lot of poverty and misery for a lot of people, and it's going to lead to depression and suicides and all kinds of bad things. So, you know, it's not a simple decision to just say, let's shut down our economy and save people's lives in the short term, because this is going to have a lot of ramifications. So anyway, that's, you know, again, I'm not an expert in that area, but I just saw that there was going to be a lot of pain, and I think there's still going to be a lot of pain. And I personally believe that markets are still pricing in kind of a best case scenario, that we're just going to open up our economy and everything's going to be hunky-dory, and that just seems pretty unlikely to me from here going forward.
right. No, I agree with much of what you're saying, and it is scary. And I think part of why I want to do as much as I can in terms of speaking to people, and you know, you have to find people that you feel like-minded with, and hear what they have to say in their perspective. And I totally agree with you that people are assuming best case scenario. Everyone's talking about a V-shaped recovery, and perhaps they're not realizing the ramifications of a lot of what's happening. I see in our mortgage world, people are the amount of people that are applying for mortgage forbearance that either don't need it or need it. And to me, regardless of those situations, the mortgage markets can't handle that type of default. And whether or not it'll impact someone's credit, I mean, is irrelevant right now. The point is, what happens to servicers when they can't pay their investors? It's going to have a ripple effect. And you know, what happens to the commercial markets, and what happens to retail and all those businesses who, as we were discussing earlier, you know, what happens to the people who adjust their business based on how they've been functioning now. So there's definitely going to be a tremendous ripple effect. what kind of, in your mind, what kind of a crisis are we in right now in terms of, forget about the, what may happen in 30, 60, 90 days from now. Why is oil at trading at negative levels? Why is the Treasury giving, trillions of dollars in stimulus to businesses, to individuals? What is wrong with the markets right now that they're just literally trying to, hose every part of every single aspect of this? Are the banks in trouble? Are retail in trouble? Is the economy? What kind of a crisis is this?
Well, this is something that we've never faced before. And I think all the comparisons to 2008 or even the Great Depression completely misses the mark. This is not a recession. This is not a depression. We're not talking about, a typical recession is, for whatever reason, demand is not there, right? Consumers spend less. This is not a demand problem. This is not all of a sudden we've decided we're not going to go, spend money. We're not going to go out to restaurants. We're not going to go to ball games anymore. This is a government imposed shutdown of the economy. And whether it's warranted or not is not the issue, right? This is a supply shock, not a demand shock. We've never had that before. So traditional tools don't work. Now the Fed came in, central banks around the world, they came in, did the right thing, but you can't solve that problem with traditional tools. The only way to solve that is through fiscal policy. So the only way to deal with the fact that you're basically not letting the economy function, or large portions of the economy function, is for the government to come in and print money. And that's what they've done. They're bridging the gap until the economy opens. They're providing relief for individuals so they can feed themselves and they can pay their bills, and that companies can survive. And that's necessary. If you don't do that, then you would have Armageddon and social unrest all over the place. So the government has to do that. Now, there are going to be long-term ramifications. They're probably going to lead to inflation. I personally believe that just like, 2 decades ago, if you told people that we were going to have zero interest rates or negative interest rates in parts of the world, people would have thought you're crazy. I think that people don't realize we're probably going to have double-digit interest rates again sometime in our lifetime. Everyone thinks you're crazy for saying that now, but that's probably going to be a result of this somewhere down the road. But right now, we're doing what we have to do to survive. I think the key question, though, is, or the key theme is thinking about, you mentioned a V-shaped recovery. How are we going to get a V-shaped recovery? Let's say best case scenario. Everything's great. We have testing, a vaccine comes out, we all go back to work. So you're telling me that all of a sudden people are going to get back on airplanes. Everyone's going to go, business travel is going to resume just like the way it was. We've all learned from here, Zooms work really well. Everyone's just going to go back and get on a plane and visit customers again, right? People are going to pack stadiums and sports is going to resume as it always has. People are going to pack restaurants again, right? We're not going to get back to the same level of economic activity we were at, even in a best case scenario. So look, I hate to be a pessimist. As a investor, I've always been a value investor. I've always been biased to buy dips. But I think this is going to be a really, really slow recovery. You can't just shut down an entire economy and expect it to just come back 1, 2, 3. It just doesn't work that way.
Right. Yep. No, I totally agree. And just to be clear, I'm not in the camp of the V-shaped recovery. I think that's superly optimistic. You touched upon, and it's perfect as I don't want to say start to wrap up, but as we're getting to the final stage over here, because I don't want to take so much of your time, and I really appreciate your time. What happens to the bond market and interest rates, and you touched upon it, when the Fed is printing so much money? We see it in other countries. Do you think and you mentioned, and I believe the same thing, that with inflation comes high rates. It is the arch enemy of bonds and mortgage rates for us. So where do you think the 10-year U.S. Treasury, do you see it going negative? And then when do you think that inflation starts to kick in with all this money that's been printed and we start to see rates spike up drastically? I know you can't predict, but do you think it is a drop lower and then a spike higher, or do you just think that this is our bottom and expect things to only go higher from here?
Well, if you watch all my TV appearances, you'll know that I never answer that question.
Yeah.
I really think that's not predictable in the short term. I will say this. The Fed in the short run, or maybe in the intermediate run, is not going to let rates rise. They will buy as much long end paper as they have to keep rates low, because if they don't, it will undermine everything they're doing. So, can rates go negative? They absolutely can.
Do you think they will?
The Fed is, that's hard to say. The Fed's not going to, I think it's very unlikely the Fed will actually take the short-term rate negative like has happened in Europe. It has huge implications for our whole money market industry. I think it's very unlikely that happens, but I think the long end of the curve could go negative. I don't know if it will, but it could. I think that's very much going to be the case for the next couple of years, because it would undermine everything they're trying to accomplish. But in the long run, it's hard to see. We're printing money like never before. We're going to run budget deficits. And this is with a Republican Senate and a Republican president. Who knows the future of politics, but, if a Democratic controlled House and executive office could see spending go to kind of different levels. There's a populist movement around anyway. The trend is certainly in that direction. So, I think the chances of much higher interest rates in the future is, 5, 10, 20 years from now, I think is high. When exactly that's going to happen, that's hard to predict.
Is there any reason you think that we didn't have that same high interest rate market post 2008, after all the quantitative easing? How come we didn't go high? In fact, it was like a stagnation in terms of just we had deflation. Why didn't the same thing happen after that recovery?
Well, I think you have to look at it on a global basis, right? There was a lot of excess capacity on a global basis. We are a very interconnected world. You had rapid growth of emerging markets that created a lot of demand that soaked up some capacity. Look, inflation is still a concept that economists, both theoretical and practical, don't fully understand what causes it. There's many factors, so that's why it's not at all well understood, and that's why it's not a guarantee that it happens in the future. It would stand to reason, though, that printing money at an unprecedented level will impact it at some point.
Right.
But again, that's a hard thing to wrap our hands around as well.
So one final question before I leave you with any parting thoughts. If you were to take out a mortgage in this environment, would you recommend to people a fixed rate, an adjustable rate? How would you strategize in that way, assuming somebody's buying a house for the long term?
Well, look, that's always, to me, it's an asset allocation question. Like, it's not, I don't give one standard advice to someone.
No, I'm not saying what you would do. I'm not saying what you would do. I'm saying somebody who has no savings and cannot do anything better with their money.
Well, look, someone who has no savings should lock in, rates are very low, should lock in for as long as they can. Someone that has financial means and it's a matter of what's the most optimal thing, you always go for the lowest thing, because rates are just as likely to be higher or lower in the future. We had this discussion many years ago when I got a mortgage through you, Shmuel. I opted for for an ARM, saying that rates are just as likely to be higher or lower. You can't predict the future. I'm willing to take the risk. It's a risk tolerance question. For someone who has no savings, they should definitely lock in, and their earnings power is on the future. They should lock in the lower rates at this time.
And I'm assuming, all right, so I'm going to leave it at that. I appreciate your time. Any parting thoughts in general for any optimism that you see?
Yeah, look, the optimism is we always bounce back from these things. Investing is a long-term probabilistic exercise. If one takes a longer-term view, one should really not try and time markets as much as people like to do. For younger investors that are just in their kind of savings years, right, market pullbacks are usually a good opportunity to to put money to work. And while no one knows what the future is going to be, and we're going to continue to have volatility, right? Cheaper valuations can be a good thing for longer term investors. So everyone shouldn't panic. No one should react to short-term market movements. And the most important investing advice anyone can give is that what makes a successful investing over time is not finding the hottest stock or the best thing to invest in a given time. It's to have proper risk controls, proper asset allocation, and stick to a long-term investment plan.
Right. No, I couldn't agree more. Thank you so much. I really appreciate it, Gershon. Have a great day. Stay safe, you and your family. And again, I truly appreciate it. Be well.
Thank you, Shmuel. Thanks for having me on.
Thanks everyone for joining.